update for the year with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. How's the month been for yourself, Andrew?
It's been a very good month, yes. Some good weather.
Lucky you.
Oh dear. And also, I think it's a bit better news on the investment front as well.
It's looking better. There's a lot of positivity.
Yes, and it's taken a long time coming, but I think now we've got two recordings in a row where we've seen positive growth without any negative side effects, which is the first time for, I think, probably 19 months.
Well, hasn't it?
It certainly has. So hopefully things are getting better now, which is good.
Given this is the final market update of the year, I guess we're sort of a review. So if we look back at the start of the year as to where we are today and what your expectations were and how you think everything sort of panned out, Andrew.
Yes, well, I think right at the start of the year, we were expecting China to be the country that was going to give us the big growth going into 2023 with them unlocking. And the Chinese did just that. So in February, they unlocked, a lot of the restrictions were lifted, but it didn't really have the impact that most people were expecting, primarily because China's got its own issues behind the scenes, especially concerning property and debt. Having said that, though, the Chinese economy is still expected to grow by over 5% this year, which we get quite excited when the UK economy grows by 0.1 or 0.2%. So its 6-year average is around about 9% growth a year, so it's sort of almost half of what you would expect in a normal year. But given the tumultuous effects of the COVID pandemic in China, I think it's not too bad, actually. The other thing that was expected was, I was reading some of the articles in December, January of this last year, and some of the well-known banks and investment houses were predicting oil to go around about $150, $160 per barrel. Well, it did go high for a good part of the year, but then fell back considerably, and it's fallen back to around about $70 to $75 a barrel, which helps then the world in terms of inflation, as we're quite sort of tied up with the price of oil, the price of heating and lighting, etc. So that's had a really good effect, I think, on the year. Unfortunately, we've still got conflicts. So Ukraine goes on, and I don't think anybody was expecting that to finish anytime soon. And then we've got the issues in Israel at the moment, which don't exactly help. But these are all things that we generally sort of have to take into account when we're giving financial advice, which is why we give it for a longer period. And then the big one was hoping that inflation was going to start to fall, which it has done. So back in October of last year, the UK inflation was at 11.1%. So getting it down to, well, more than half of that, 4.6% was the last figure we got out, which is good. And it's been the same for most of the rest of the world as well, that inflation now is starting to fall. And I think it really backs up what we were saying right at the beginning of this, that the inflation, the huge spike in inflation was all caused because of the lockdowns and then people being allowed to go back and start spending again. And shortage of products, shortage of services, and when there's a shortage, price goes up. I think it's reflected in the fact that when we look at the unemployment numbers, they're not much changed to where they were before the pandemic. In fact, in the UK, we've got more people in work now than we did when the pandemic started. So that's another good sign, really, that the world isn't too bad. So we've got here in the UK, for example, 4.2% unemployment. The Eurozone has got around about 6.5% unemployment, and in the US it's 3.7%. I was just looking a bit further back, in the UK, average rate of employment from 71 to 2023 was 6.7%, with a high of 11.9% in April '84, and a low of 3.4% way back in December 1973. So before you were even born.
A long time before I was born.
Yeah. So that's what we were looking forward to for this year. And I think we said at the beginning of the year, didn't we, it was going to be probably a tough one. And it certainly has been.
So an up and down year, but where has the growth been for this year, Andrew?
Well, for this year, it's been a very good time indeed for European companies and European funds. The Europe funds that we recommend have actually been the best performing over the last year, and also the best performing over 5 years, which has taken the crown away from the US equity funds. So a very good time for a number of companies in the Eurozone, which is good, having that exposure. America's been a solid performer. I think the difficulty with America, as we said before, is with this magnificent seven, it controls so much of the equity market. And if we take those 7 companies away from the index, it's been a fairly average year for most American stocks, as it has been for UK growth as well, in terms of the FTSE 100. Smaller companies are still getting a bit of a battering, but they tend to go down first in terms of a recession or when things get tight, and then they come out fighting. So I would expect that going forward, smaller companies are going to start putting on the pounds and the growth as confidence starts to return. We're starting to see a bit of movement again in our fixed interest investments, so lending money to companies. Good growth this month from the UK gilt funds, that's lending money to the UK government. But we've got to remember that these funds took a heck of a battering last year. So our policy for years now has been to try and keep an eye on the fixed interest side of things and have some exposure to it, but not the sort of exposure that you would expect in sort of a 60-40 type portfolio, 60% equity and 40% gilts. We think that's just too much. In terms of world growth, then I'll just do some digging to find out which economies have grown the best over the year. In terms of countries, then it's Guyana takes the lead. Do you know?
But you give me a quiz again. I would never have picked that country, that's for sure.
I'll give you a quiz in a minute. So Guyana, 38% growth in its GDP. So that's its output. Staggering.
Yeah.
In terms of regions, then Macau in China, the Las Vegas of Asia.
Vegas, it is Sim City, Sim World over there.
Ah, right, okay. Let's take your word for that. That's up 74%. Ooh. And here's one for you. Your friends in Samoa, how do you think their economy's grown? Not quite as dramatic as those two, but still good positive.
It was a World Cup year, wasn't it, for them? So they must have done okay. And they did all right in the World Cup.
So your guess will be?
Well, not as well. Oh gosh, Samoa. They do well.
Yeah,
15%.
Oh, well, not quite as well as 15%, but 8% growth for Samoa. So yeah. So they're showing good signs of growth. Lots to come for the next year.
With 2023 in the books, when we look ahead to 2024, what do you expect?
Yeah, I think hopefully, fingers crossed, that we're going to see interest rates start to fall. There's already talk at the moment that both the European Central Bank and the Bank of England have raised interest rates by too much, because inflation figure in the Eurozone is now down at 2.9%. The target is 2%, and it's coming down fairly quickly. So there is pressure now on a lot of sectors to get the cost of borrowing down. So hopefully we'll start to see interest rates fall, which will then stimulate the economy. The other thing is that we need to get debt levels down as well. And to get debt levels down at a national level, then again, you need to stimulate growth, because if you have fairly mundane performance, you're not bringing the taxes in that you need, or you have to increase taxes even further. And the UK, you see now, we're at an all-time high in terms of taxation, which does nothing long-term to stimulate the economy. So hopefully we're going to see a reduction in taxes, especially in the corporate rate, and we're going to start seeing interest rates reduce, which will be very, very good news. The big boy for this year, for the end of the year, has been markets speculating that interest rates will start falling into next year. So that gives them some confidence, and we would hope that continues. It could be we'll see one or two more failures from companies that are trying to refinance. Most of the refinancing is into 2025, so it gives companies time to prepare for any shocks in higher borrowing costs. But I think we're going to be fairly well positioned, touch wood, for a good year ahead. Predicting hopefully some decent growth ahead. But as always, it's a long-term thing. Long-term, as you know, we make considerable returns. Short-term, that's something we can never predict. And some of the reports I've read from earlier in the year just show that even the people that paid millions and millions of dollars, pounds, and euros to pontificate about, they get it badly wrong. So it's really an educated guess, I think we're doing it. And we don't get it too far wrong in terms of the funds that we pick for our clients, because what we're looking for is good long-term quality. And I think if we stay with that, then we're going to see some really good returns 2024. Good time to invest, always a good time to invest. Cash rates will start falling. We've been seeing rapid high cash rates from over the last 20 years compared to, I think we're going to start seeing people moving away from cash into more active investments once they start seeing the numbers coming through, when they can open statements and say, oh, I'm actually making money this time, rather than it's going down again. So we'll keep our fingers crossed, and yeah, it's very positive for your guys again, retaining the Ashes. Controversy.
Good year with sport, wasn't it?
Yeah, it was the fifth
everything really, wasn't it?
Very well done. Yes, grudgingly. So yes, that's good. I think 2024 a much better year than 2023, and definitely a lot better than 2022. Hopefully, lessons are learned, and we'll continue to make money.
So I guess the final thing is just to discuss the rebalance. So we've sent out emails and videos to every single client in our files, and I think we're just waiting on a handful. And if you're one of those handful, if you can just reply to us. We've had some fantastic replies. One great reply, wasn't it? A champion reply, a video that we got back that we'll be sharing with all of you. You can actually watch this at the end of this video. So make sure you stick around and have a look at that and see what kind of replies we've gotten. And congratulations to that individual. We'll be sending out a lovely Christmas hamper to you. But yeah, more like that would be, I guess, make the job a bit easier for us, wouldn't it? If we get replies like that. Happy, lucky ones. And
exactly. Well, it's a very serious job we do, but
it is, yeah.
It's good to have a giggle now and again. So.
Yeah, so thank you to all that have replied to our initial email and our communication. If you haven't, then please pick up the phone or send us a wee message, and we'll get that.
Here, frog. What? I'm sleeping. Did you hear the ARD are making changes to their investment portfolios? What kind of changes? They're partnering with us. Build a bear. Oh, yeah, that's exciting. You know what I'm gonna do? Oh, no. Come on, we need to make a good impression.
What's going on? Ding, ding. Crazy.
Updates. We'll go through all the ARD consultancy portfolios and how they performed over the last month, last year, last 5 years, and the last 10 years. And as we always do, we'll start with the defensive.
So the defensive, the last month is up 3.16%, over the year up 4.39%, 5 years 15.8%, and 10 years 59.4%.
And the cautious portfolio?
This month up 3.42%, over the year 4.43%, over 5 years 24.7%, and 10 years 85.4%.
The balanced portfolio?
This month we're up 3.65%, over the year 4.33%, 5 years 32.5%, and 10 years 113.7%.
The Capital Growth portfolio?
This month up 3.85%, over the year 4.17%, 5 years 38.1%, and 10 years 134%.
Finally, the aggressive portfolio.
This month up 3.96%, over the year 4.76%, 5 years 44.9%, and 10 years 158.5%. A very Merry Christmas and a Happy New Year to all of you. Cheers!
Cheers!